Hello and welcome to this episode of InFocus. I am your guest host, Candis Fitch, Portfolio Manager here at TriCert Investment Counsel, joined today by fellow Portfolio Manager and baseball fan, Brian Durno. Welcome, Brian.
Thanks, Candis.
Today we're here to chat a little bit about the consumer sector. So could you give us just a high-level sector update to start before we get into some nitty-gritty details?
Sure. Yeah, and I may end up providing you a few of those nitty-gritty details as I give you a recap here. But we'll start the consumer sector for us. I'll today cover consumer staples sector and the healthcare sector that we sort of lump into our consumer grouping at this juncture. So let's just start maybe in the consumer staples sector. Just as a reminder to listeners, this is sort of a category that is generally characterized by very stable earnings and, staples meaning things that you tend to buy even if times are tough. Something like soap or dish detergent, these kinds of things, dishwasher soap, these kinds of things that you would buy no matter what. Right. So they tend to offer, high levels of stability. But yeah, so why don't I give you a recap? So just with respect to the business performance, which is what we like to focus on the fundamental side of things, this most recent quarter was just basically completed a few weeks ago, and the consumer staples sector produced about a minus 6% growth rate in their earnings. So that's actually a decline in their growth rates year over year. Revenue growth was pretty flat for the group, so that's kind of where the sector landed. Of course, we don't own the whole sector. We own our favorite stocks from the sector. But I might just point out as a group, the sector was trading, a little bit more expensive than the average in the marketplace, but not out of line with where it normally trades. It normally does trade at a little bit of a premium because of the stability in this sector. So maybe I'll give you a couple highlights how that compares to some of the stocks that we have collected our portfolios around under the hood compared to this sort of the average. So as I say, the growth rate from the staples sector was around minus 6 for the quarter. Compared to our group, we only had one stock that had negative growth rates. The rest in North America had positive growth rates, so we did a little bit better fundamentally on that side. I might caveat all this short-term, quarter by quarter discussion. It is something we pay very close attention to, but our time frame for holding these stocks tends to be very long. Right. But it is important to keep track of how the companies are performing fundamentally. As a matter of fact, actually all four of the stocks that we sort of covered on the North American side this quarter, and own in the portfolio, they all beat their expectations, which was kind of nice that they did a little bit better than expected because expectations were kind of high coming into the quarter.
And what about healthcare?
Yeah, healthcare, there's some interesting things happening in healthcare. This sector has been kind of, let's just say, left behind by the market in the last little while. And that has led to, let's say, more reasonably, well, even you might argue cheap valuations from the sector as a group. But you really do have to look at the growth rate there to find out if it's a value trap or if it actually is valued correctly. But the actual absolute level of valuations from the healthcare sector are not only cheap against the market, but cheap against where they normally trade relative to that market. So it's just kind of an interesting area to look at for new ideas. The growth rates from the quarter in that sector, the top line grew around 8% or so. The earnings growth rate was actually very, very confusing this time around because Gilead and Bristol Myers, who are in this sector, had extraordinarily high levels of growth that kind of confused the growth rate from the sector. But if you strip them out, the growth rate from this grouping of stocks was roughly around 9%. And our stocks, actually as a collection underneath the hood, did a little bit better than that. All the stocks in our grouping in the healthcare sector produced positive growth rates year over year, except for one. So that was pretty good fundamental performance. And I thought maybe I would share with you just a couple details about some of the, let's say, more quality characteristics from this group. Yeah. As you know, we tend to populate the portfolios with very large companies. So the average size of the company that we invest in the healthcare sector is about $180 billion. So they've been through.
So pretty big. Yeah.
Yeah, totally. They've been through a lot. And one of the other interesting factoids that doesn't get talked about a lot is just let's say the consistency. Healthcare can be another relatively stable and attractive area, but they do depend on R&D and these kinds of things to keep their earnings growing over a long period of time. So I thought I'd share with you the number of years on average that these holdings that we collect our portfolios around have increased their dividends. So
Okay.
it ranges from our highest one is 63 years of continuing increasing dividends. So 63 years in a row. That's quite a long time. If you averaged out all the holdings in the portfolio, you're looking around 35 years in terms of consistent number of years of dividend growth. And it's nice. Yeah, this group trades roughly around 15 times earnings, which would compare to the market around 2021. So like I say, pretty high quality businesses. Return on equity is around 41% for our average company that we buy, and this great, excellent track record of dividend growth.
That's fantastic. And I know almost every stock that we buy pays a dividend. And a reason for that is obviously it's a signal to us as portfolio managers of if the company is making enough profit to be able to share that profit with its shareholders. That's a really big quality metric for us. I'd like to maybe rewind a little bit and pull on the staples sector for a little bit. You chatted about, they've seen, I don't want to say rough waters, but maybe less than expected growth rates or lower than maybe last year. Can you tell us just a little bit more on that in terms of some of those quality metrics and why we still like them? I hate to say the dreaded R word of recession, but I think staples are a place that we seem to run to in times of concern. So I'd love to hear what your thoughts are on that and maybe some of those quality metrics of those stocks in particular.
Sure. Yeah, there has been some, let's say, gray clouds out there about, discussions about recession and the effects of Liberation Day down in the States and the effects that's having on the economy. And I can say the staples sector and the healthcare sector both combined tend to be the sectors that can still deliver reasonably good fundamental performance during a recession. So they tend to be areas that attract a lot of capital during recessionary environments. So in spite of the fundamental results we're seeing here today, if there were to be some sort of macroeconomic event like a recession or something like that, I would probably still be very comfortable saying that these two sectors would be, let's say, more stable than some of the other sectors that have more cyclical natures in their revenues and earnings per share. But yeah, you're asking about the staple sector. So they're almost in some cases a little bit of a victim of their own success. Coming out of COVID, many of these companies exhibited a great deal of pricing power. And I might just say that, this is one of those things that fundamentally when you're investing in equities, you actually really are concerned about inflation eroding your purchasing power. So when you buy a company that flexes its muscle and shows that they can raise their prices without affecting their volumes too heavily, then you've basically found a company that's going to be able to protect you from inflation over the long, say, 10 or 20 or 30 year period. Right. It's never fun as the consumer to pay those prices. But it is one of those fundamental factors that you want to make sure that the company has the ability to raise their prices over time to deal with rising costs in their own business. So some of the growth rates, when you compare this year to last year, they're comparing against tougher comparables there. But I can say, we do watch the volume pretty carefully. Like, you can only raise prices so much before people will actually stop buying and substitute other goods. And I can say probably as a group, this consumer staples sector has probably reached near the end of their capacity to pass through tremendous amounts of pricing power. They'll still be able to, in my opinion, keep up with inflation. But these huge, double-digit increases in prices are hopefully behind us as consumers.
Yeah, not a great thing for consumers, but definitely a good thing for investors to see that kind of power in the marketplace. Well, thank you, Brian, for all of your insights today. Wonderful hearing from you and what's going on in the consumer sector.
Thank you.
Of course, if anybody has any questions about the information you've heard today, please reach out to your advisor at your CPA firm or your TriCert Investment Counsel portfolio manager. Take care.